Mark of a good and experienced trader, they rarely blame the market. They know that the market's going to do what the market does, and their ability to...
Yeah, I can do this one, yeah. There is a great statistic, and I haven't got it to mind, but you should Google it and look it up. And if you had accurately timed the market, I think the S&P, on a daily basis over like 5 years, literally, you know, in and out the market at exactly the low of the day and come out at the high of the day. If you completely time the market perfectly, it's something insane, like $1 would have compounded to $1 billion in literally like a couple of years. But nobody has done that. Why? Because it's almost impossible to time a market, you know, consistently. You know, if you really, nobody can do it. It's really tough to time a market. That's the reason why on my, you know, personal investments, I just put money, you know, money I can save month by month in the market. I mean, admittedly, there are times when it's just glaringly obvious that you need to put your money in there. So, for example, in the midst of the Eurozone financial crisis in 2011, European stock markets got down to single-digit PEs. Now, that doesn't happen very often. I think it happened in the 70s in the UK when the FTSE got down to around a 7 times PE. But when stock markets on single-digit PEs, that was a screaming buy. Of course, the world was going to hell at the time and nobody wanted to buy stocks. But there are big moments when you just know that something is fundamentally mispriced. You know, at the height of the 90s boom, I experienced the 90s US boom where the market went up, 20% a year. And the S&P got to a 30 times PE, something like that. You know it's been time to get out, but timing it is very, very difficult. Look at the bond market. We know with base rates at 0.5%, 10-year yields at 2.5%, we know that the bond markets are massively overvalued. But timing that exit, very difficult. Everybody expected this year would be the year that US Treasuries perform poorly. Actually, they've done very well. Timing markets is very tough.
Do you think now is a good time to get out of the market with the current sort of geopolitical situation?
I have a very long-term view. I don't trade the markets day to day. Frankly, I haven't got the time. But I have a very long term. I'm 44. My time horizon is 20, 30 years. I would never buy. Because I have this long-term time horizon, I wouldn't buy bonds. I would never buy bonds at this level. Why would you buy a gilt at 2.5%, a 10-year gilt? Inflation's likely to be more than that. Why would I deliberately destroy my money? I don't understand that. So I would be 100% invested in equity. And if it goes up and down, I don't care. On a 20-year view, equities will perform well. History shows us that. History also shows us there are long periods of underperformance and long periods of outperformance. But hopefully, if you put money in month by month and if you have a long-term time horizon, that's kind of irrelevant.